Hello, good morning, everyone. Welcome to lecture number 2. In this lecture, we will talk about material costing, recording, and documentation. As we identified our aims and objective of this module, the module aims to develop student understanding of the fundamental aspects of management accounting and accountants. So, if we want to understand the fundamental aspects of management accounting, we should know how we maintain the records regarding materials and how management accounting uses the information of materials in case of making decision. And this chapter is also lies in the very beginning learning objective. Understand and apply costing techniques in relation to material, labor, and overhead in different business contexts. So, costing and controlling materials, perpetual and periodic inventory accounting. This is the title of the chapter that we will be looking today, which includes basic concepts of material costing and what are the methods of recording materials in the books of accounts, like first in, first out, last in, first out, or average costing. And also, there are two basic different costing system, that is perpetual inventory accounting and periodic inventory accounting. So let's start. As we see the bigger picture in this diagram, we see a bigger picture of the whole accounting system of an organization, which ultimately provides the information to the external people for decision making. But before we provide information to the external people, we need to generate those information. And it basically starts with material costing, material documentation. Because the production process of an organization starts with materials. Okay. So the records regarding materials is the foundation of the overall accounting system of an organization. And what are the aspects we record in material costing or reporting materials? So we see the material that we purchase, the material that were available in the organization before when we start the accounting period, beginning or opening raw material inventory, the material that we used for producing products, that is material consumed, and also ending raw material inventory. So how can you calculate raw material consumed? So based on these three components, material that were available in the beginning of the accounting period, plus raw material purchases, you can say net raw material purchases. If there is any kind of other expenses we need to add, like transport in or freight in, and also we need to deduct if there is any discounts that we receive, if there is any returns from purchase that we need to deduct from here. So raw material general purchase plus freight in, transportation in, and deductions of discounts, returns, allowances. Then we'll get net raw material purchase, and we have to add this one with beginning raw material. Then we'll get total raw materials if we add this together. And then if you deduct what the material already or still available at the end of the accounting period, if you deduct that, then we will find raw material consumed for production. And this is one of the fundamental elements of manufacturing cost of goods manufactured. As we defined in our last lecture, the raw material cost and direct labor cost and other direct expenses and overhead altogether, which combines or determines cost of goods manufactured. Obviously, we need to adjust work in process, that is incomplete goods of production. So how we maintain documentation and what's the process of acquiring raw materials? So the process actually starts with production departments, the department which requires raw materials, which needs raw material to use for production. So firstly, organization determine what they want to produce. And then based on the production, they determine what are the raw material we need. So after identification of the required raw materials, they prepare a purchase requisition. And this purchase requisition they send to purchase departments. Then purchase departments identify which organization they can order the products. So the document then goes to supplier. They identify the cheapest supplier, quality supplier, and then they order the products to the supplier. And then the same copy goes to accounts department for reference in future. And also the purchase department send the same copy to the stores, go down, where the products will come from the supplier. Then if supplier happy with the order, if the terms and conditions and everything is okay, then supplier sends the products or goods to the organization, which is being received by the godown or stores. And when supplier supplies the products, they provide the details. What are the products they are supplying? What are the color, rates, quality, prices, all the details they provide with it. And then the godown or storekeeper make a goods receipt note. So the products that he is receiving or he received from the supplier. And then that goods received note is being provided to the purchasing department, accounts department, and other departments, so that the accounts department can pay for the purchase. So the details of these is being provided in the next slide as well, next two slides. So you can see the details here. When the inventory falls to a minimum level, then the reorder is required. So purchase requisition is sent by the buying department. The buying department checks item in the lists listed and send a purchase order to the supplier. When the material arrives from the supplier, the driver of the delivery vehicle brings a delivery note, which the storekeeper sign after checking against the quantities received, nothing, and also if there is any discrepancies, shortages, missing, damages, they identify that. And also, as I mentioned in the previous slide, the storekeeper prepares a goods receipt note. Then the copy is being sent to the buying department and also accounts department for payments. And After receiving the material, when the material arrives, accounts department gets a supplier's invoice showing the quantities and the material supplied and prices charged, etc. And accounts departments compare what has been ordered, what has been received, and what's the price, and what's the total payments. If everything is correct, then what accounts department pays the amount to the supplier. Finally, the material is sent to the production as required. So the goods is in the store, and then production department asks for the materials when it needs, and then material goes to the production department for being used in production process. So this is a kind of um, graphical presentation of the works, how it works, and also it depicts the execution process using technologies, what is being used now at the moment. So raw material lot control is usually the manufacturing cost of the organization is being recognized as control accounts or lot controlled. So, and as you can see everywhere, it is mentioned lot control, lot control, lot controlled. So firstly, raw material arrived, and raw materials and intermediaries, if there is anything before, and then these raw materials goes to the production process, and some of the materials may remain as work in process. And then combining with the raw materials and the previous work in process together, after completion of the works, they got finished goods. And the finished goods, from the finished goods, the organization sells products to the customers, and that is being shipped or delivered to the customers. This is a kind of life cycle of the material, how it works in a manufacturing enterprise. So based on the previous discussion, if we see how the organization maintain the documents. For example, here is an example. Transactions. What are the transactions happen? Like identify and explain documentary evidence that supports Chocolate Limited account system for June transaction. So buying department's authority to order new supplies of cocoa beans. So when production department needs some raw materials, then they prepare a purchase requisition. Based on their requisition, buying departments. So that requisition comes to the buying departments, and buying department is the authority to order for new supplies of the raw materials. That's chocolate manufacturing company use cocoa beans. Suppliers authority to send cocoa beans to Chocolate Limited, and that's the responsibility of the suppliers. So when the supplier say they have available materials and they are happy with the prices and terms and conditions, then they send the materials to the manufacturing organization, that's the purchaser, the buying organization. So when the cocoa beans or the raw materials arrives to the store, at the store in good condition and expected quantities or the quality, but in that case, the supplier provided a supplier's note, delivery notes, and the storekeeper identifies what he receives and prepared goods receipt notes, which the storekeeper transferred, so provided to the accounts department, to the buying departments, to make them understand that what they have ordered before is being received, and accounts department can take necessary steps to pay to the supplier. Correct quantity and prices on supplies invoice, that is being identified by the storekeeper when he receive the goods or the products supplied by the supplier, and authorizes release cocoa beans from the store of the beans for conversion to the chocolates. So actually the products is being maintained, stored in the stores, go down, and based on the necessity of the production process, the raw material comes to the production department in the factory for being used in the manufacturing or conversion to the chocolate, manufacturing or processing chocolates. So in the production process, two situations sometimes happens. If you use the raw materials, if there is nothing wrong in the production process, nothing wrong happens, it will go straight to the finished goods. But in some cases, there are some wastages happened, waste material in the manufacturing process because of any defects, because of any kind of technical problem. The waste of the raw materials happen. This is being recognized as waste. It's the wastages that you can't sell. That's actually the loss of the organization. It has no value. But in some cases, you can produce some low quality products in the production process. Maybe it is kind of broken or something happened, or it becomes kind of inferior quality that is recognized as scrap. So the scrap is kind of defective product that you can sell, but you can sell it as a uh, low quality products at a lower price. Okay, so the cost of materials that is being um, processed as waste or scrap are indirect material cost. That's also recognized as total production cost of the organization. And any cash received because of this scrap or wastages, because of defective products, is deducted from the cost of buying materials. In some cases, you ordered raw materials at a price, but because of the market condition, because of um, supplies, maybe supplies of the raw material increased or decreased, the prices of the raw materials can change. So if there is anything, something like that, how you should, as a manufacturing organization, how you can deal with and how it can impact your costing system. So supplier change price based on the necessity, based on the situation, based on supplies. If this is the case, material arrive at a different times at a different price. So where the price that you expected, you are not receiving the materials at that price. How accounts department decide on the unit price charged jobs. So how you will be recording that price in your books of accounts, what price you will charge. So you can identify the price when you receive the products. So accurate leveling on arrival is time consuming in some cases. So you have to receive lots of products in the we have to get all the deliveries at a time. So it can be difficult to level all the products with correct pricing at that time, and only used for high value and low volume items. So accurate leveling is done if number of products is lower and the value of the products is really, really high, so that when you use it or when you go for selling the products, then you can recognize that these are the products that came at a different price, and you have to sell at a higher price, or you can sell the products at a lower price. So if it is a high value product, high price products, and number of products or the volume of product is low, in that case, it is possible for you to level the products when you receive it. But in most of the cases, it is not convenient. In most times, convenient and approximate costing is used. Okay, so what does that mean? Means it's approximate. So you have to estimate what is the, it's not about only the price, it has also some other costing. So you can charge an average estimated cost, and then you can record it as a cost of the materials when you receive the products from the supplier. Or if it is not possible to level appropriately or estimate, it's not possible to estimate all the cost. In some cases, it may happen. So in that case, you can use a standard cost. Whenever you receive any products, what's the standard cost you estimated at the beginning of the accounting period? You can record your materials that you received at that standard cost. Standard costing you will learn in future at some point. So the materials that you received is being recorded at a standard price. So inventory systems, as I mentioned before, two main types of inventory accounting system, perpetual and periodic. So these are two different systems, and it depends which organization used which one. It depends on the nature of the products and types of the organization. Basically, the main difference I want to mention here is how often you are recording the materials in the system. Are you recording continuously, or you just record once whenever you have the opportunity? Particularly, more specifically, at the end of the accounting period, once in an accounting period. So what are the differences between perpetual and periodic? In case of perpetual, as I mentioned before, in case of perpetual, a detailed records and continuous records of the changes of the materials is being recorded. Continuously, you are recording the materials that you receive, the material that is being used, the material that is being sold or transferred to the production process, the material that is missing. Whenever any changes happen to your materials is being recorded in details with quantity and prices and values together. But in case of periodic, now no attempt is made to keep the details of detailed records. Okay, so in case of perpetual, quantities and price of the cost is being tracked each and every time whenever there is any changes in the products, in the goods. But in case of periodic, no record, continuous record is being maintained in cost and prices or the quantities of the products. So in case of perpetual, so continuously, whenever you wish, you can find out what's the cost of materials, what's the cost of goods sold, or what's the materials that you used and what's the materials available in the store. Anytime you'll be able to know it. But in case of periodic, as you can identify from the name, periodic means you'd be able to know this information only at the end of the period, once in a period. So how it is being worked. So in case of periodic, you will count the materials available in your store at the end of the period. For example, if you want to close your books on 30th of June, so you'll go to the store on 29th or 30th, usually on the 30th, and then you will count the materials available and then determine the price. On that day only, you'd be able to know how much materials is available, what's the cost, because of recording in the financial system. Before that, you'd not be able to know it. So it's once in a period, periodic, and in case of perpetual, discontinuous records. And there are different costing approaches, how this continuous records or the periodic system is being maintained. It can be first in, first out, or it can be last in, first out, LIFO, and AVCO, that is average costing. In case of first in, first out, what we do is we deliver the product that came into the organization first. So the product that, or the raw material that came in first, will dispatch first in the manufacturing process, or is being sold to the customer first. In case of last in, first out, the material that came last will go first. And in case of average costing, is the average cost is being used in case of determining the cost of goods sold or inventory that is available at the end of the period. But remember, in case of first in, first out, we are issuing the first item first. That is the item that we purchased earliest. So usually, as the price increases, the earliest purchase purchase price is usually low. So the material that we are issuing to the manufacturing process or to the customer is usually at a lower price. And the products or the goods remain in the store is of higher price. So the cost of goods sold doesn't actually reflect the revenue. And in case of last in, first out, it overcomes the limitations of first in, first out, But the material that is available in the stock is of the low price. The last material that came in is the latest price we are issuing first. So it matches with the revenue that we are generating now. But the inventory available in the store, that is the products that we purchased the earliest, so which are usually of low price. So ultimately, the low price inventory doesn't provide the latest or relevant information. And particularly, the last in, first out is not being recognized in UK. The HMRC doesn't allow you to use last in, first out. So in case of first in, first out, if you apply first in, first out, your cost of goods sold would be lower, and inventory cost would be higher, and your profit amount would be higher. In case of last in, first out, the cost of goods sold would be higher, inventory cost would be, the value of inventory or the cost of inventory would be lower, and in that case, your profit amount would be lower. So if the profit is lower, your tax burden, amount of tax would be reduced. And that's why HMRC in UK doesn't allow you to use last in, first out. So I already mentioned the advantages and disadvantages. So first in, first out suffer the disadvantages of matching the outdated cost against current value. So the first in, first out uses the earliest purchase as a cost of goods sold, which is kind of outdated. That cannot be, that doesn't reflect as a cost of the revenue that you generate from sales. The last in, first out overcomes the limitations of first in, first out. But the problem is the value of inventory is become lower, is become outdated. So in the next part of the video, I'll explain this exercise. Thank you very much for watching.